My next guest has some investment implications from sticky inflation. Of course, this comes on a day when the S&P and NASDAQ are both hitting fresh record intraday highs. But he's warning the everything rally might not continue if we have structurally higher inflation because of some generational shifts going on. Joining me is Aaron Dunn. He's the co-head of value equity at Morgan Stanley Investment Management. And I appreciate coming back on set as well, Aaron. Welcome to you. And let's just pick off where we were just finishing. So you also believe that we're going to have kind of stubbornly high inflation, don't you?
Yeah, I actually agree with Steve and Drew there. I think, but we've been talking about this for a couple of years now, really coming out of the pandemic, was you had this generational shift of sort of aging of the employment base, right? And you have, we all realize that. So then you also have a lower number of people coming into the workforce. So really what that drives is a lower labor force pool, and it's going to drive up wage inflation over time. And that's what we've seen, but we've been talking about that for a while. We also think that you're in a sort of the middle innings of a commodity cycle here. So there's a lot of reasons that we've felt like you're going to see inflation be a lot stickier. We've been talking about it on a multi-year basis. Drew was alluding to that as well.
Yeah.
We would actually agree with that. And again, we think 2025 is going to be very similar to 2024 with a lot of speculation of what the Fed does with rates, especially with the backup in rates we've seen.
Well, I hope today. 2025 is similar to 2024 because what do we have this year, like a 26% S&P? Maybe it's not quite that high. But what do you think the market implications of this are?
So since the election, I think we've seen a 3-4% increase in the market. We're pushing all-time highs. Valuation is not going to be a tailwind next year, right? So you look at earnings growth next year. The makeup of that is largely, if you look at sort of consensus numbers, low double digit, right? So let's call it 10 to 12% of earnings growth next year. The makeup's very different because the makeup is more cyclical in nature. Prior to, in 2024 and before, it was more big tech,
absolutely,
right?
The
and
Mag
so
7.
You do have a different makeup of that. If that doesn't happen, if there's not an economic sort of recovery, I do think you have a risk of that earnings growth number for next year. The other thing we'd really point to is the consensus bullishness that's out there.
Yeah.
We think people are fully invested. If you look at strategists that enter 24 very bearish, everyone has been completely sucked into being bullish. If you look at the average of sort of the targets for a year end in the S&P, you have upside of, low double digit, right? So when you have such a one-sided trade, in our opinion, and a one-sided positioning in the market, it really worries us heading into next year.
Listen, it's hard for anyone to disagree with that. The only thing I'd say maybe is that it just feels like it keeps going. And you think about the tailwinds into next year for growth, and it does look like there are some things that are going to be in place to kind of be helpful, but with a lot of headline risk as well. A lot of this comes down to market positioning. So are you doing stock picking? Is this kind of like sector over and under exposure? How are you approaching
We're
this?
very much focused on stock picking. And I think to your point, the one thing we really focus on is risk reward. So yes, the equity market can do well next year. It did very well this year in a similar environment, as you point out, but it's being cognizant of the downside risks. And inevitably, what's going to happen is something no one foresees, right? And you will see a big correction in the market. So we really focus on downside protection through what we look at in companies, which is good returns, an unlevered or lower levered balance sheet, good free cash flow. So we really want to focus on good businesses because that helps us retain the capital and not lose capital for clients in a down market for equities.
Yeah, I mean, if you think about it, we're up more than 20% back to back, I think for only the fourth time in the past 100
Correct.
years and the first time since the 90s. And I'm not sure we've ever been up more than 20% for 3 years in a row.
Correct.
So you'd be going out on a limb to say that we're going to continue the kind of performance that we've seen, not that we expect. So either the best case scenario is almost a mildly positive year. A more likely outcome could be something down.
Yes, it very well may be. And that's why we worry about the risk of the downside and sort of protecting the gains we've experienced over the last couple of years.
You mentioned the kinds of stocks you're looking for. Robert Half is one of them. Mid-America apartment communities, that's a REIT. Talk about those if there's any others that kind of come
Yeah,
to
Robert
mind.
Half, we were talking about employment. You had the JOLTS number earlier this week, which showed job openings actually increased a little bit. So that's a positive. And what we see is the employment picture. And if you get back to the generational inflation number we were just talking about of sort of employment is tighter for longer, you get more wage growth through that, you just have a tighter labor market. So especially I think we're going to see a lot of companies struggle to staff themselves. Let's say the economy does grow next year and quite strongly, you are going to see the need for employment to increase. Robert Half, in our opinion, if you look at the stock, has really gone nowhere now for a couple of years, but it's a business that is net cash. It's earned high return on invested capital, close to 30%. It's an excellent business. It just hasn't been the most favorable employment environment in the near term. term. So if you do surprise on the upside for employment, we think this one's going to do extremely well.
And then real quickly on Mid-America,
MAA,
is a REIT play a weird thing to recommend if you think rates might be stickier? Or?
In theory, but I think one of the big issues here is housing. Right, and so we're underbuilt in housing. So what that means is more people need multifamily. Mid-America is a big Sunbelt multifamily company. And so what you've had over the last year and a half is new supply come into the market. Coming out of the pandemic, you saw supply increase, rates were low. You saw this big push of new supply coming in for multifamily. That's going away.
Yeah.
So you're going to have multifamily supply really tighten up. And then they're in markets where you see population growth, right? So we think that all is going to lead to really good rent growth. We don't know that rates go higher from here. We're just less worried. We're more worried they don't go down much.
That they stay around these levels.
Exactly.
Absolutely. Aaron, thanks so much for bringing these ideas and this thinking. We appreciate it today.
Thanks,
Aaron Dunn with Morgan Stanley.